Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover many topics related with balance sheet and statement cash flows. In this video, we're going to talk about the usefulness of the statement of cash flows. Cash flow is another performance measure of a particular company besides the accrual net income. Of all these three sections in the typical statement cash flows, the operating activity sections is the most important section. The operating cash flow is the most important cash flow of company because this part of cash flow is generated from the major operation, the daily operation of a particular company. So it is also called the lifeblood of a company. So in this video, our cash flow analysis will focus on the operating cash flows. First of all, we can use the operating cash flow information to calculate the free cash flow. What is free cash flow? People talk about free cash flow all the time. How do we calculate free cash flow? It equals net cash provided by operating activities minus capital expenditure. Capital expenditure refers to those money spent by business or organization on acquiring or maintaining fixed assets such as land, buildings, and equipment. Those information could be found in your investing activity sections. So, free cash flow are those cash flows that company could use for many purposes. For example, they could use to invest in another new project. They could use this money to pay off debt. Anyway, those are the cash flow that is available for general corporate usage. And more importantly, this free cash flow is less subject to accounting trickery resulting from accrual basis net income. So free cash flow is really about the net cash flow you have right now instead of the income. Next, we can use operating cash flow to calculate this operating funds ratio. It equals operating cash flow divided by net income. So this ratio tells us that for every $1 of net income, how much operating cash flow can be generated or converted to. So this ratio tells us the portion of business cash flow provided by our earnings. If a company has a very small operating funds ratio, that means that lots of their net income is not realized in cash yet. When we use this ratio, we also need to consider the life cycle of a particular company. During the expansion of firms, operating funds ratio could be less than 1 because lots of their young companies, net income is not realized in cash yet. For a mature company, this ratio could be greater than 1. Next, people also use operating cash flows to calculate this cash conversion ratio. It equals operating cash flows divided by net sales. So it tells us that for every $1 of net sales, how much operating cash flows is realized. It reveals the extent to which sales revenue is converted into cash. This ratio could be big, could be small. When this ratio is small, that means that accounts receivables are increasing. When this ratio is large, it means that receivables are decreasing. So accounts receivable explain the difference between the numerator and the denominator. People also use operating cash flow to evaluate financial liquidity. For example, we could calculate current cash debt coverage ratio. It equals operating cash flow divided by average current liability. This ratio measures how much operating cash flow this company has to cover every $1 of current liability. So this ratio indicates whether the company can pay off its current liability from internally generated cash flow. Lastly, people could also use operating cash flow to measure financial flexibility. For example, we could calculate the cash debt coverage ratio. It equals operating cash flow divided by average total liabilities. So this ratio measures how much operating cash flow this company has to cover every $1 of total liabilities. So the higher this ratio, the better. This ratio indicates company's ability to repay its liability from operating cash flow that is internally generated without having to liquidate assets employed in its operation.